Capping credit card interest rates sounds like common sense. And that's exactly why the system doesn't like it. This week, Donald Trump called for a temporary cap on credit card interest rates, framed as an affordability move for consumers dealing with high borrowing costs. Supporters see relief, critics see risk. By the end of this video, you'll understand what the proposal actually does, why it's being described as temporary, and why even a short-term cap forces the credit system to respond. No hype, no speculation, just what the reporting says, translated into plain English. According to reporting from CNN, Politico, The Financial Times, and Business Insider, the proposal is described consistently. A one-year cap, explicitly temporary, focused on affordability, not restructuring debt. That framing matters. This is not being pitched as a permanent rule. It's not described as rewriting how credit works. It's positioned as short-term relief during a period when credit card interest rates are widely seen as expensive. In policy terms, this is a very specific move. Apply pressure briefly, then step back. But here's the part that rarely makes the headline. Credit card interest rates aren't arbitrary. They exist to price risk. Credit cards are unsecured loans. There's no house attached, no car to repossess, no asset backing the debt. If a borrower defaults, the lender absorbs the loss. That's why credit card interest rates are structured differently from mortgages or auto loans. The pricing isn't just about profit, it's about uncertainty. Those rates cover default risk, operating costs, and the reality that some balances are never repaid. A cap doesn't remove any of that risk. It simply limits how much lenders can charge to take it on. That's not a political statement. That's how unsecured credit works. This is where finance does something unintuitive. You make something cheaper, and suddenly fewer people qualify. Capitalism doesn't argue, it recalculates. The logic behind the proposal is straightforward. High credit card interest rates are expensive for people carrying balances. A temporary cap lowers interest costs in the short term, without permanently changing the system. That's how it's described in the reporting. Short-term intervention. Not a long-term overhaul. Lower the pressure, don't redesign the engine. That distinction matters. It signals intent. This is relief, not revolution. But systems don't pause just because a policy says temporary. The Financial Times highlights concerns raised by economists and industry observers. Not predictions. Concerns. The issue isn't whether lower rates feel good. It's how lenders behave when they can't price risk freely. The reporting points to potential responses like tighter approval standards, lower credit limits, or fewer offers to higher-risk borrowers. This isn't framed as punishment. It's framed as adjustment. If upside is capped while downside stays the same, behavior changes. That's not banks being cruel. That's banks responding to constraints. Banks never say, "We're cutting people off." They say things like, "We're reassessing exposure." Which is corporate for? Yeah, probably not. A lot of the public discussion treats this as universally positive. Interest rates go down. Everyone wins. But the reporting doesn't say that, and the structure doesn't support it. Credit systems don't distribute relief evenly. They concentrate it. Borrowers already inside the system are more likely to benefit. Borrowers closer to the margin may see access tighten instead. That trade-off isn't hidden. It's built in. And that leads to a second misunderstanding. It's tempting to frame this as a moral argument. High interest is unfair. Lower interest is fair. But the reporting avoids that framing. This isn't about judging borrowers or lenders. It's about how risk moves when pricing is constrained. A cap doesn't eliminate risk. It relocates it. Same system, different pressure points. In finance, the door is always harder to open than it is to keep closed. That's not cynicism. That's design. None of the sources claim this will eliminate consumer debt, or permanently fix affordability, or fundamentally restructure household finances. That restraint matters. This is positioned as temporary relief, not a permanent promise, which makes it easier to sell politically and easier for markets to wait out. A cap like this doesn't eliminate risk. It just decides where that risk is allowed to sit. And in financial systems, the most important changes are rarely the loud ones. They're the quiet shifts in who still gets access and who doesn't. That's money mechanics. I'll see you in the next one.